Well, welcome everyone. Here with me today is Dan Habib. He's an executive vice president of MBS Highway. And if you're familiar with them at all, they pretty much are the source for data about what's happening in the mortgage world, at least to me. It seems like all of their forecasts are accurate, and they make it easy to understand what's actually going on in the market, so you can understand, do you want to purchase now? Do you want to refinance now? And those kinds of things. So, Dan, thank you so much for your time here. Can you give us a little bit of background about you and your history in the mortgage world?
Yes, so thanks so much for having me, and thanks for the kind words on some of our insights. We really try to do a good job of taking everything happening in the marketplace and really making it easy to understand and digestible. To give you a little bit of background about myself, I've been in the mortgage industry for roughly 18 years. It almost seems like I was kind of born into it. My father being Barry Habib, some of you may be familiar with him, one of the top producers, and then created companies like Mortgage Market Guide and now MBS Highway. So I was kind of born into that. And previous to this company, though, I did work at Morgan Stanley as a financial advisor. So held all my different licenses and things like that. But really have a big passion for helping both mortgage professionals and real estate agents to navigate through, the markets, the home buying process, and eventually to help the consumer like you guys.
Yeah. Yeah. And I think that's the cool thing is MBS Highway is the thing that kind of turned me on to like, oh, we can actually help people through this process more than just giving a generic rate or a generic mortgage, is actually seeing how can we structure this in a way that helps people gain wealth in the future. So, what's happening right now in this market, it's so hot. Everyone's getting frustrated with how many offers they're putting in. We're seeing prices, the Case-Shiller appreciation report just came out, 10.4% appreciation in 2020. Are you seeing that potentially continuing, or where do you see home prices going in the next few years?
This is a question that I get a lot because some people out there are feeling like, hey, we saw 10% roughly appreciation in 2020. Did I miss the boat? Right now you start to see rates
Yeah.
moving up a little bit. Some people out there are wondering if they should wait to purchase a home. The quick answer is no, you should not. You should still be looking to purchase a home today, because I think the strength in the housing market is going to continue into the future. And what I'd like to do is just show you a couple slides that kind of support my thesis here for why I actually think you're going to see not a correction in housing, but I believe you're going to see somewhere around 7.5% appreciation in 2021 on top of the appreciation we already saw. And I think you'll see that it's not rocket science. It's rocket science as to why we're coming up with these conclusions. So let's take a quick look here. And I'm going to go ahead and just share with you why I think demand is going to be increasing first. So this is something that's already happened. Okay. It already took place. But if you want to find out, hey, how many people are going to be coming to market to purchase a home or to rent a home, well, you can look back at birth rates. And if we would agree that, listen, this number is a little bit of a sliding scale. Some people think it's 33, 32, 34, but let's just say the median age of a first-time home buyer is 33 years old. So if we went back 33 years ago, it would bring us right around 1987 or so. And you can see that's right here on this chart. So you could see how many people were born since 1928 all the way up to 2012 here, and it breaks it down into generations. So 1987, this is where 33-year-olds today were born. What do you see happening the next year, the following year after that, the year after that? It almost looks like a staircase. It's showing you that there was a greater amount of births each subsequent year. And what that means for us is that even though we saw really strong demand in the housing market last year, it's going to be stronger this year, it's going to be stronger next year, and it's going to be stronger the year after that. So when you have more demand coming into the market, that's always a good thing for the housing market as far as supporting prices goes. Now, it's important to also look at the supply side of things. So we know we have increasing demand. When we look at supply, well, supply was already near record lows. But what happened with COVID? You had, the beginning of COVID, builders out there who thought that it was going to have a negative impact on housing. It wasn't going to be as strong as it eventually ended up being. And builders, if you take a look at this big hole here, they stopped building homes. So you already had record low inventory levels. And then you have builders stop putting homes up there. It's a recipe for even tighter inventory. You can see actually this chart, we just got some new data. So it's actually 1.04 million homes for sale, not 1.07. So this is the lowest on record. And you do have people out there in our industry, in the housing market, saying we're going to see a big correction. We're going to see a 30 or 40% correction in housing. I don't see it that way. And if you want to see what a housing bubble looks like, if you want to see what some of those periods look like, well, take a look here. Take a look at '07. Take a look at '86 and '87, where you had peak inventory levels, 3.7 million homes for sale. That's what a bubble looks like. You need to have, something to sell for a bubble,
Mm,
right? So right now you have increasing demand and you have the lowest inventory on record at 1.07. That's not bubble-like conditions. That's a recipe for stronger and hotter home prices. And if you take a look at the number of households, if you look back at '07, there was 116 million households in the U.S. If you look today, or I should say at the end of 2020, 128 million. So you have 8 million more households in the U.S. and you have almost 3 million fewer homes for sale in the U.S. And we also have vacancies that are at all-time lows, which is going to be supporting home prices too. It's not like you have a ton of inventory out there that isn't being utilized. So, my feeling is that you're going to see home prices supported in 2021 and going forward. And I don't think
yeah.
builders are going to be able to keep up with this tight inventory issue. I mean, they have a lot of challenges out there. You have lumber, which is up over 100%. They're having some issues with labor and things like that. So I think that you're going to continue to see this housing train continue forward. And if you
Yeah.
thought you missed out last year, if you wait another year, you're going to feel the same way. So
Right. Yeah, and that's it's almost terrible to look at that data and see it see it all displayed in front of you, because I feel like I used to be in that camp where I thought, you assume like everything's going to be a little bit cyclical. Of course we're feeling the pressure of it now. We would assume that it would start coming back down, but when you start seeing all that data, you start to recognize, no, this is going to take a while for any sort of correction to happen in the future. So do you have an idea of what that looks like as far as a timeline? Is that something that's like 3 to 5 years out in the future? Is that possibly shorter or longer?
Well, I don't know that we're going to have to see like a big correction like we saw. Remember the market is very different than it was, during the housing bubble, right? I mean,
Hmm.
a lot of it was due to, a lot of bad loans being done out there and a lot of speculation. The market has changed for the better since then. Do I think that after this year, going into like the following 2 years or so, we're going to see a big slowdown in appreciation? Yeah. But do I see negative prices? No, I don't see that. And again, it's simply just due to supply and demand. And I think that
Yeah.
a lot of it's going to be localized too, right? I mean, there might be some. I'm talking from a broad scale here, as far as like across the U.S. where appreciation levels are and things of that nature, and inventory levels. But you have to also realize that real estate is localized, right? You could have some markets that are really overcooked that could have some bit of a
Sure.
correction, right? And you could have some that have underperformed that may then go ahead and perform better. But from a nationwide perspective, I think that we're going to see another really strong year of appreciation. And then following that, you might see some subsequent years where you're seeing, maybe 3 to 4% appreciation. But I'm not seeing, unless I start to see the data change drastically, I'm not seeing or
Yeah.
forecasting any type of big, housing correction event in the foreseeable future.
Yeah, and I think a lot of people have that fear that they think that they're buying at the top just because they see the pressure happening. And I think they assume that, well, if I buy this house and it already feels overpriced, that I'm going to get in there and all of a sudden the value is going to tank. And obviously we don't want that, but it almost looks like we're kind of at the beginning of this happening just based off of even the birth rate data that you showed in there and the lack of inventory that's been able to keep up.
Well, I want to show you something, and it's something that the media, I think, puts in a lot of people's heads, and it has to do with affordability, right? So I think affordability is a hot topic, right? We've
Yeah.
seen 10% appreciation over the last year, and we're forecasting more appreciation. People are thinking, maybe they missed the boat. They're thinking homes are expensive, but I think that if you take a look at some actual numbers, homes are more affordable than they were last year, even though we've seen this appreciation. Let me just show you this chart real quick here. So the media oftentimes, I think, gets a lot of things wrong because they're not very good at math, and you have to remember their focus is to get eyeballs, right? But
Right. Yeah.
the media talks about, hey, there's an affordability crisis, there's an affordability wall, and this is what they cite. They say, hey, listen, the median home price is up 16%. And, if we look at incomes based on average hourly earnings, they're up 5%. So they say, hey, listen, homes are up 16%. Incomes are only up 5% year over year. Things are getting way out of hand and they're unaffordable. But, you have Diana Olick coming out saying things are unsustainable. Adam Data Solutions saying housing is miles away from being affordable. But here's the thing. They're looking at the wrong metrics, right? Now, yes, we have seen some strong appreciation, but it's not the median home price. See, what happens is every month we get an existing home sales report, a new home sales report. And what it does is it shows you what the median or the middle priced home that sold was. So if you remember back to like your economic days, you had your average and your mean, right? And you had your middle or your median. So, it was around 314,000 or so in the last report. So what does that mean? That means that half the homes sold beneath 300,000, half the homes sold above that. So it was literally the middle priced home that sold. And when you compared that number to what the number was at the same time last year, it was up 16%. But that's the median home price. It doesn't mean that home prices are 16% higher. And if you take a look at why this number was so much higher, it has to do with the mix of sales. If you look out there, there's no inventory on the lower end. In fact, lower end homes, the sales of them were down by over 15%. Homes on the higher end, over 1 million, are up by nearly 90% or so. So there's more expensive homes being sold because there's no inventory on the low end, and that drags the median home price higher. So it looks like the median price is up 16% year over year, but that doesn't mean that homes are up that amount. So the media looks at the wrong figure. How much is real appreciation? Well, you said it at the beginning of this call, roughly 10%. Now, average hourly earnings is important. It shows how much people are working per hour. However, what if your hours got cut, right? Or it's not showing what your actual take-home pay is, which is why we prefer to look at weekly earnings. And weekly earnings aren't up 5% year over year. They're up 7.5%. So you might look at those two numbers and you might say to yourself, okay, Dan, well, we're looking at the right figures now. Appreciation of 10%, not 16, and earnings up 7.5, not 5. And you might look at that and say, well, they still don't seem to be keeping pace. Homes still look to be getting more unaffordable, or less affordable, I should say, because appreciation is outpacing earnings. But hold on a second. So people often forget that you don't use 100% of your income for your mortgage payment or for your home payment, right? So let's just use a simple example. Let's say that last year we could have bought a home and the home was $1,000 in principal and interest. And this is going to be an oversimplified example to show you how this works. And in order to qualify for that home, it wouldn't be uncommon if somebody had an income of, let's say, $5,000 a month. Now, the income number doesn't specifically matter. The point being that you never use 100% of your income for the mortgage payment. Okay, so it could be $4,000. The point is that there's a relative relationship there. Now, remember, we didn't buy this home last year, and home prices, as we said, went up 10%. So again, simple example here: your principal and interest payment would go from $1,000 a month to $1,100 a month. Now, your income, in order to match that $100 rise, how much would your income have to go up? Well, the answer is not $10,000 in this example. 10%. In this example, it would only be 2%, because your $5,000 a month income would only have to rise 2% to match that $100 increase. So here's the point, team, is that your incomes never have to keep pace with appreciation because of the relative relationship between your income and your housing expense. So, the fact that we're actually seeing, we're seeing incomes rise by 7.5% and homes rise by 10%, theoretically speaking here, you'd actually be able to support much higher appreciation than we're currently seeing. And homes are actually getting more affordable at this rate with incomes going up at this level. And I think people don't really understand that because of the relative relationship between your income and your housing expense. And then there's one more I just want to show you as like a real life example here, right? So if we could purchase a home in the first quarter of 2020, it was a $300,000 home, right? And then if we looked at the first quarter of 2021, after the 10% appreciation we saw, it would be a $330,000 home. So this is many of you asking yourself this question. Oh, listen, could have bought the home last year. Now it's up. It's $30,000 more expensive. Am I buying at the worst time? Am I buying at the peak here? Well, remember, we think that we're going to see appreciation in addition to this of 7.5% or so. But let's break this down. So if you took out a mortgage, let's say you put 10% down, which is a common down payment, right? Last year, or I should say Q1 of 2020, it would have been a $270,000 loan amount. Now, because the home appreciated by $30,000, the loan amount now is going to be $297,000. So the loan's going to go up by $27,000. But if you look at the rate is about 3.75% last year versus roughly 3% this year. Now, listen, the numbers can change here a little bit depending on who you're speaking with, but the point being is that rates are roughly 0.75% lower than they were at this time last year. Now, your principal and interest payment, when you compare from Q1 of 2020 to 2021, is $1,250 versus $1,252. So pretty much the same principal and interest payment. You're $2 more expensive today. And when you look at mortgage insurance, it's going to be $10 more based on the MI factor. So in total, you're going to be $12 a month more expensive if you buy the home today versus buying it before the 10% appreciation that we saw over the last year. But remember something, your monthly income went from $5,000 a month to $5,375. So your income increased by $375. So, I ask you, did the home get more affordable or less affordable? It's almost a wash on the actual expense of the home. But remember, incomes went up by 7.5% on a year-over-year basis. Your weekly incomes, your money that you take home. So I think this is an important example to go over and explain to people that, listen, you didn't miss the boat. Homes, when you compare them, are still extremely affordable. Now, listen, if rates start to go dramatically higher from here, could things on the affordability side change a little bit? Of course. But that's why right now is a great time because, yes, we've seen a little bit of a bump up in rates, but rates, historically speaking, are still extremely low and attractive. Yeah. And you still have a great opportunity ahead of you in housing.
Yeah. Yeah. I'm sure there's no news company that wants to hire you to write headlines. Because it's not as attractive as, homes are becoming unaffordable and appreciation is 15% and all that. The sky's falling. But it's nice to see those numbers because then you can see, home prices are increasing. We did see incredible appreciation in 2020, but there's two pieces of core data that are on our side. Is we can see statistically where home prices have a higher likelihood of increasing over 2021 and possibly into a couple years into the future. And like you mentioned, not reversing or declining back, and that affordability piece included with how much lower rates are now than they were, even if they, we had this slight uptick, are still lower than they were this time last year. So you have that broader affordability piece coming in where people can still buy a home and still be able to benefit from that purchase without the fear of everything kind of falling out.
I agree with you. And I think that, right now it really kind of illustrates how important it is to work with a professional, right? Somebody that's plugged into the market, for a long period of time, really since, over the last year until like the last couple of weeks, the market's been really stable. The Fed has done like a masterful job of keeping interest rates stable, like through COVID and things like that. But now there are some fears out there of inflation. There's some talks that we could see inflation, and just even like the talk of it and the anticipation of it, we're not even seeing real inflation yet, has caused interest rates to spike a little bit and some volatility. Yeah. And, for those of you out there that are shopping for homes, it's really important to make sure you're talking to a professional, someone like yourself, because, a mortgage is not a cookie cutter thing. And a lot of people try to present it in that way, and one of the things that, of course, is going to be near and dear to you is what's the interest rate, and people are going to have different rates. You have to take a look at that, closely, because some people could manipulate them, but also, people are going to, offer you a rate, but are they going to execute on that rate? And one of the things that you may not be familiar with is rate locks, right? You have a certain window of time that you can lock in that rate and preserve it, right, until you're closing. But rates are always changing, and right now we're seeing a lot of volatility out there. So it's important that you talk to somebody that is plugged into the market, that is monitoring this stuff for you. And literally it's something that trades on the bond market, much like stocks that you guys watch, right, in your own portfolios. Interest rates are directly tied to something called mortgage-backed securities, which trade on the bond market. And if you're not talking to a mortgage professional that's watching this for you and monitoring it, well, you can get caught, and surprised by a rate change where rates can get worse on you. So I think that that's important. But getting back to the first thing I said is that, rate's important, but having the lowest rate on the wrong strategy is going to be much more expensive for you than having a competitive rate on the right strategy. And a mortgage is not a cookie cutter situation. And, you can talk with somebody, a professional, that can show you how you can, use your refinance or use your home purchase to set up future financial goals that you have for yourself. If you're doing a refinance,
Yeah.
Most people out there have a lot of equities in their homes. So, your typical loan officer might just try to refinance you into a lower rate, which is great, and adjust the term. But hey, maybe you have some debts and some equity that we can pull out of that home and pay off some of those debts and really set up your financial future and show you how you can use your mortgage to save for things like your kids' college or for your retirement
Yeah.
and things like that.
Yeah. I feel like the thing that solidified me really liking MBS Highway is I did a using your guys' debt consolidation tool, um, helping someone through a move up purchase, where instead of them taking all the money from the equity of their sale and putting it on a down payment, I showed them what it would look like to take that money. Let's do a smaller down payment and let's pay off most of the debt that you have in credit cards and all these other things. And that was going to increase their net worth by making that decision by $200,000 compared to just putting the down payment on this new home. And so it's things like that. People need to be looking for in a loan officer, not just somebody who's going to say, here's a low rate, good luck, but the fact that sometimes the rate doesn't always drive the larger decision that's going on with how it's actually going to impact the bottom line for us. Because when I look at my bank account, I don't get to see the interest rate of my mortgage. What I
Mhm.
get to see is what's the overall net worth that's going on, what's the broader financial picture in here. So one last question I have for you is there going to be a foreclosure crisis? You have all these foreclosure bros, as people are calling them, who are saying the
Mhm.
world's going to end, forbearance is going to end, and then we're going to see all these foreclosures hit the market.
I don't think so. I don't. I think it's something to keep an eye on, but I don't think we're going to have a crisis there. It's a great question because they keep extending these foreclosure moratoriums and they've extended like the ability for people to go into forbearance, which for those of you that don't know, basically means that you can kind of pause on making your mortgage payments, and like you can like reapply on this for like up to like a year, but then you do have the ability afterwards. Like at first when this came out, it was like unclear as to when this had to be repaid. Some people thought it was like, oh, you have to pay it in a lump sum after that year, but
Hmm.
they've basically made it a little bit more gentle where you can kind of tack this on to like your mortgage, right? Or pay it when you refinance or when you close, when you sell the home, I should say. But the real thing is that with foreclosures, they're going into this, they were at like really low levels. Like I think it was like 0.03% of all homes were like in foreclosure, right? But people have equity in their homes. About 200,000 on average, according to data that I recently saw from CoreLogic. So if you have $200,000 of equity in their home, you're going to protect that equity before you foreclose
Hmm.
on the home.
Right.
So, luckily we're in a housing market now where homes are freaking flying off the shelves. I mean, the average days on market is like 17 days on market. If you're running into an issue where you can't pay your mortgage, I'd assume that people would go ahead and sell that home, which, as we said, they're flying off the shelves, and protect that $200,000 of equity they have before foreclosing on the home. I mean, that would just make logical sense. And I
Hmm.
think most people are going to be in that type of a situation. There's going to be some issues, I'm sure, but I don't think it's going to be this like huge forbearance foreclosure problem that people are forecasting.
Yeah, absolutely. Well, I appreciate it, man. Can you tell us a little bit about your partner with Certified Mortgage Advisor? So this is a program that basically helps loan originators become a strategic advisor for their clients. And so there's actually a way that if somebody's looking for somebody who can help them with debt consolidation or refinances or following the bond market, they can get connected with somebody who's certified through that program. So can you explain a little bit about that and how they can get connected?
Yes. So the certified mortgage advisor designation is essentially the best education that a mortgage professional can get within the industry. It is a pretty vigorous course that is going to be testing them, and they have to then pass this extensive course and test in order to get the certified mortgage advisor designation. And this really is something that differentiates the loan officer, by having this, but also just by their knowledge and making sure that they are setting up their customers with the best loan that fits into their plan and their financial future. So, of course, I would recommend if you're out there searching for a mortgage, to make sure you're using somebody that's a certified mortgage advisor or somebody that you really trust to handle this situation, because it's probably one of the largest financial transactions that you're going to make in your life, and it affects so many things. And it's not a one size fits all kind of plan. Rate's important, but the rest of the plan is also very important as to how it fits into the rest of your life there. So if you wanted to, you can actually search for certified mortgage advisors in your area. So just go to certified mortgage advisor and search in your state, in your area, for that you could work with, that you know that are going to be really well educated and able to help your specific situation.
Yeah, yeah, and I'm going through the program right now, and it's fantastic, and it's actually pretty hard. It's very thorough, so it's been good going through that, and I've learned a ton. So yeah, I'll have that link down in the description, so you can go search find one in your state, and be able to get connected with them, and they'll be able to walk you through a lot of the tools that MBS Highway has that can help you, understand more that your loan is not just the rate that you have, but it's actually the strategy that's going on beneath it. But Dan, thank you so much for your time here. I really appreciate it, and tons of information and actionable knowledge in here. So I really appreciate that.
Hey, thank you for thanks for having me, and thank you everybody for listening. I hope it was helpful. And listen, in summary, I still think that we have a really good opportunity in housing. Now's a really great time, especially with some of the turbulence that we're seeing in interest rates. But I do think overall, towards the back end of this year, we will see rates come back down because of the massive amount of debt that the U.S. has incurred, which historically speaking, in every country, throughout every time in history, when you have debt climbing as much as it has been, I mean, after the latest stimulus deal, it's going to be around 30 trillion. It does have a downward pressure on inflation, on the velocity of money, and on interest rates. So I think you'll see some turbulence, but I think towards the end of the year, we'll see rates cycle back a little bit lower. I think housing is going to be a great opportunity, but as always, it's important to work with a professional like Kyle here to make sure they help you through the situation.
Awesome. Thanks, Dan.
Thank you.